If you live in Canada, you've probably felt it. A sense of economic unease, the soaring cost of housing, the sting at the grocery checkout, the feeling that despite working hard, you're just treading water. Well, that feeling isn't just in your head. It's reflected in a single staggering statistic that economists are calling a ticking time bomb for the Canadian economy. We're talking about Canada's debt-to-income ratio. It's not just a number on a spreadsheet. It's a story of how we live, borrow, and struggle, and it has profound implications for every single Canadian, from homeowners in Vancouver to students in Halifax. And for our viewers in the US and Australia, don't click away. While this is a Canadian story, it's a powerful case study in economic risk, and the lessons here are universal. Today, we're diving deep into Canada's debt-to-income time bomb. So, what exactly is this ratio? It's deceptively simple. The debt-to-income ratio, specifically the household debt to disposable income ratio, measures the total amount of household debt, that's mortgages, car loans, credit cards, and lines of credit, compared to the annual disposable income of all Canadians. Disposable income is what's left after taxes. In simple terms, if the ratio is 180%, it means for every dollar of income we have after taxes, we owe $1.80. Let that sink in. As of the latest data, that number in Canada is hovering around 174%. That means the average Canadian household owes nearly 1.74 for every 1.7 of income they earn in a year. Now, to put that into a global perspective, this isn't just a high number. It's a world-leading number. Canada consistently ranks among the highest, if not the highest, in the OECD for household debt. Compare it to our southern neighbors. The US household debt-to-income ratio sits at around 100%. They went through their reckoning with the 2008 housing crisis, which forced a massive deleveraging, a painful process of paying down debt. Canada, shielded by a strong banking system and stimulus measures, didn't have that correction. Instead, our debt kept climbing. Australia, you're in a similar boat to us, with a ratio around 185%, making this a common challenge for both our nations. So, while the US serves as a contrasting example, Canada and Australia are walking a very similar tightrope. So, how did we get here? How did Canada become a world leader in debt? The story has a primary villain and a few accomplices. The main culprit, without a doubt, is the astronomical rise in real estate prices, particularly in our major cities like Toronto, Vancouver, and Montreal. For 2 decades, housing wasn't just a place to live. It was a guaranteed investment. Prices seemed to only go up. This created a frenzy. To get into the market, Canadians had to take on massive mortgages. First-time buyers stretched their budgets to the absolute limit, often taking out mortgages that were 5, 6, even 7 times their annual income. And it wasn't just the principal. The government's stress test, while well-intentioned, arguably pushed people towards more expensive, uninsured mortgages. And existing homeowners, seeing their equity skyrocket, treated their houses like ATMs. They took out huge home equity lines of credit, or HELOCs, to renovate their kitchens, buy new cars, fund vacations, or even invest in more property. The house became the foundation of not just our living, but our spending. The accomplices to this housing-driven debt binge are low interest rates and easy credit. For over a decade, following the 2008 financial crisis, we lived in an era of historically low, almost free money. The Bank of Canada slashed rates to stimulate the economy. This made borrowing incredibly cheap. Those massive mortgages, the monthly payments felt just barely manageable because the interest cost was low. Credit card companies and banks were falling over themselves to offer pre-approved lines of credit with enticingly low introductory rates. This environment normalized debt. It wasn't something to be avoided. It was a tool to be leveraged. We shifted from a culture of saving up to a culture of buying now and paying later. This combination of soaring asset prices and cheap credit was a potent cocktail, and we drank it eagerly. But a time bomb needs a trigger. For decades, the bomb has been ticking away quietly because those ultra-low interest rates kept the fuse burning slowly. The trigger, the lit match, has been the unprecedented rapid rise in interest rates. To combat the fierce inflation that followed the pandemic, the Bank of Canada and other central banks around the world had to slam on the brakes. They raised interest rates at the fastest pace we've seen in a generation, and suddenly, that manageable debt became a monster. Let's talk about what this means for people on the ground. For millions of Canadians with variable rate mortgages, or those nearing renewal, this is a financial earthquake. Imagine taking out a mortgage at a 2% rate a few years ago. Your monthly payment was, say, $2,500. Now, at renewal, that rate could be 5% or even 6%. That same mortgage payment could jump to $3,500, $4,000, or more. That's an extra $1,000 to $2,500 every single month after tax. Where does that money come from? It doesn't magically appear. It comes from cutting back drastically on everything else: groceries, entertainment, savings, and retirement contributions. This is why you're hearing more and more stories about people who have good jobs but are still using food banks. Their fixed housing costs have exploded, and it's not just mortgages. Those lines of credit used to buy cars and boats, their rates have shot up too. Credit card debt, always punishing, becomes even more crushing. This is the crux of the time bomb. It forces a massive shift in consumer behavior. When such a large portion of the population is forced to divert more and more of their income to service debt, they stop spending on everything else. And consumer spending makes up about 60% of Canada's GDP. If consumers stop spending, the entire economy slows down. Retailers suffer. Restaurants close. Businesses see lower profits and may stop hiring or even start laying people off. This creates a negative feedback loop. Job losses make it even harder for people to service their debt, leading to more cutbacks and a deeper economic slowdown. This brings us to the most feared outcome, a wave of defaults. If people simply cannot make their payments, even after cutting back on everything, they face impossible choices. They might be forced to sell their house, but if economic conditions are worsening and interest rates are high, they might not be able to sell for what they paid. They could end up selling at a loss and still owe money to the bank, a situation known as negative equity. A wave of forced selling would put immense downward pressure on the very housing prices that created the debt in the first place, potentially triggering a sharp correction in the market. This is the nightmare scenario that keeps bank economists and policymakers up at night. It's not just an individual tragedy, it's a systemic risk to the entire financial system. Now you might be thinking, the banks are strong. They passed the stress tests. And you're right, Canadian banks are among the most resilient in the world. They are much better capitalized than their US counterparts were in 2008. The stress tests ensure they can withstand a significant downturn. This means a 2008-style systemic collapse is highly unlikely. But that doesn't mean it would be painless. The pain would just be distributed differently. It wouldn't be the banks collapsing. It would be thousands upon thousands of families facing financial ruin, a deep and painful recession, and a generational setback for the Canadian economy. The bomb might not destroy the entire building, but it could still shatter countless lives within it. So, what can be done? Is there a way to defuse the bomb? The solutions are complex, and there are no easy answers. The Bank of Canada is in a terrible bind. Its primary job is to control inflation, which requires higher rates. But higher rates are what's priming the debt bomb. Cutting rates too soon could reignite inflation, making the cost of living crisis even worse. It's a delicate balancing act. The federal government could pursue policies to increase supply, especially housing supply, to address the root cause. But building millions of new homes takes years, if not decades. They could also look at measures to boost productivity and incomes so that Canadians earn more, making the debt burden relatively lighter. But again, these are long-term strategies for a problem that is causing acute pain right now. For you, as an individual, the focus must be on what you can control. This isn't about fear-mongering. It's about empowerment. If you have debt, especially variable rate debt, now is the time to create a fortress around your personal finances. Create a bare-bones budget and see where you can cut. Every extra dollar should be going towards paying down high-interest debt. If you have a mortgage renewal coming up in the next few years, start stress testing yourself now. Calculate what your payment would be at 6%, 7%, or even 8%. Can you afford it? If not, you need a plan. Could you extend your amortization to lower the payments? Would you need to sell? Talking to a non-commissioned, fee-only financial planner can provide a clear, unbiased path forward. The goal is to get your personal debt-to-income ratio as low as possible, to build a buffer against whatever the economy may throw at us next. Canada's debt crisis is a ticking time bomb, fueled by decades of cheap money and soaring real estate. The fuse is lit. The only question is how it explodes. For everyone watching, be prudent, be prepared, and focus on what you can control.